The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Ian King with Ben Boulos. These are your headlines this Tuesday morning. Brent prices on pace for their biggest monthly gain ever, but easing back slightly overnight on a Wall Street Journal report that President Trump could be willing to end the war without reopening the Strait of Hormuz.
But for now, the fighting shows few signs of easing as Iran strikes a Kuwaiti oil tanker off the coast of Dubai. The White House insisting Trump still wants to strike a deal, despite threatening to wipe out Iran's energy infrastructure.
He wants to see a deal over the next 10 days. That timeline is waning, several days left, and we'll see. I won't get ahead of it. We'll see what happens in the end of the 10-day period.
Markets draw an historically volatile March to a close. The Nasdaq in correction territory and the Stoxx 600 eyeing its worst month since March 2020. But Fed Chair Jerome Powell offers investors some signs of relief.
No one knows how big it will be. It's way too early to know. As I mentioned, we do think our policy is in a good place for us to wait and see.
Crude prices have whipsawed in what has been a volatile session so far amid mixed messaging around the potential for future escalation in the war in Iran. The Wall Street Journal has reported that the president has told aides he's willing to end the war in Iran without reopening the Strait of Hormuz, sending prices lower. Well, prices spiked in early trade following the news that a fully laden Kuwaiti oil tanker was struck off the coast of Dubai, sparking a fire which UAE authorities say has since been extinguished. Well, on Monday, President Donald Trump said in a post on his Truth Social platform that great progress has been made in negotiations with Iran, but threatened strikes against oil wells and Carg Island, as well as electricity and desalination plants, if the Strait of Hormuz is not, quote, immediately reopened and a peace deal reached, quote, shortly. Well, Dan joins us now from Dubai. Dan, what's the latest on this Kuwaiti tanker?
Well, Ian, good morning to you. That situation's still evolving, although authorities here say a fire on board the tanker has now been put out. And of course, on the diplomatic front as well, as you've been discussing, the Wall Street Journal reporting that President Trump is willing to end this US military campaign against Iran, even if the Strait of Hormuz remains closed, possibly leaving Tehran in control of the world's most critical oil shipping lane and kicking the question of how to reopen it down the road. And of course, the timing of that report is striking because, as I've just mentioned, overnight we saw Iran striking a fully laden Kuwaiti oil supertanker anchored in a Dubai port. The Kuwait Petroleum Corporation confirming that attack and also saying the vessel, which is called the Al Salmi, suffered hull damage and a fire broke out on board. All 24 crew members are safe, but KPC is warning of a possible oil spill in a major shipping anchorage. And that is significant, not just from an environmental perspective, but also an economic risk perspective as well. The UK Maritime Trade Operations placing the incident about 31 nautical miles northwest of Dubai. And what also makes this significant is the fact that it is the latest in a series of Iranian attacks on Gulf shipping. And it also comes as Trump simultaneously threatened on Truth Social to, quote, blow up and completely obliterate Iran's power plants, oil wells, Carg Island, and possibly all desalination plants too, if the strait is not immediately reopened. So we're seeing two contradictory signals from Washington in the space of just hours here. One suggesting the president is ready to wind down without resolving the strait. The other threatening to obliterate Iranian infrastructure. And of course, markets now are struggling to price which one is real. And as a result, we saw US oil closing above $100 a barrel overnight for the first time since 2022. Some analysts now talking about how we could see a surge towards $200 a barrel if this disruption in the Strait of Hormuz is sustained, or if we see an escalation here and perhaps the Houthis becoming more involved potentially threatening the Bab el-Mandeb Strait as well. So the situation continues to evolve on the ground here, and perhaps raising the risk that we could see further strikes on not just commercial shippers, but also critical infrastructure as well, as we see this war of words between the Iranians and the Americans continuing to evolve with no real diplomatic off-ramp emerging, at least for now. Ian, back over to you.
All right, Dan, much appreciated. Thanks for that. Well, joining us now is Dave Ernsberger. He's president of S&P Global Energy. Dave, very good morning to you. What did you make of what Dan was saying there? I mean, this talk of $150 a barrel, even 200.
Yeah, well, these are very real numbers that are out there in the market today. And what I think people are talking about when they think about big numbers like 150 or 200 is that the longer that this conflict goes on, the more that the pain that is already being felt in the physical market for barrels of oil will start to be reflected in the futures prices. One of the signature themes of the conflict so far has been that futures markets and physical markets actually have been telling very different stories. The longer this goes on, the more that story comes together.
So when does the pain start to hit the futures market?
Any day now, right? Today is the last day of March. I don't need to tell you, breaking news, right? But that's very significant for futures markets convergences into physical markets. The end of monthly trading cycles, the end of moments like that become really, really psychologically important. So I would expect to see that happening. In fact, we're already seeing it happening right now.
This notion that Trump might try and reach some sort of accommodation with Iran without them relinquishing control of the Strait of Hormuz, I mean, that potentially, doesn't it leave Iran in a stronger position than it was pre-conflict?
Well, you know, our reporters are some of the most networked in the physical side of these markets of any agency anywhere in the world. And what we hear in the market is precisely what you're talking about, which is that to come out of this conflict, when we do come out one day, with the Iranians in a stronger position than ever, would be very traumatizing for people who are trying to move tankers through these straits. For example, the Iranians are talking quite seriously about charging a toll for safe passage through the strait, and maybe that's a long-term scenario. Hard to imagine other shippers, other countries accepting that very happily.
Dave, just an interesting headline in the FT today saying the UK to receive its last tanker of jet fuel from the Middle East this week. What's the situation regarding that specifically? Because, of course, that has to be refined as well, and there are limited places where that can be done if you're ignoring Russia as a potential source.
Yeah, this actually highlights something that has been on people's minds very much, which is when do the tankers that left the Middle East stop arriving into ports, including here in the UK. And that time is right about now. So we'll be seeing the last arrivals of jet fuel, the last arrivals of crude oil that left the Middle East in February, arriving right about now. That raises a huge question about where will we get our jet fuel from in April, in May. And the answer to that question is we're going to start pulling barrels in from the United States. We're going to start pulling barrels in from other parts of the world, and that's going to drive the convergence of the headline prices we were just talking about with what's happening in the real physical market where we all consume these products at the end of the day.
A question I've put to some of our other guests on the energy and commodities front is this stat that a fifth of the world's oil passes through the Strait of Hormuz.
Yeah.
That means 80% doesn't. What scope is there to ramp up the rest of that 80%?
Yeah, that's a really interesting way of thinking about it. Unfortunately, as we learned with some of the news out of Venezuela back in January, you can clear the runway for an expansion of production in somewhere like Venezuela, which accounts for some of the remaining 80%. And to actually move the nuts and bolts around to raise that production takes a lot of time. But we will see the energy markets start to shape shift around this conflict the longer it goes on. And that means we will see production increasing from some of those other destinations. It raises the question of who has the flexibility to raise their production. And that points to a structural weakness in the market, which is that most of the flexible supply was in the Middle East. The U.S., a market-driven producer, ultimately at the end of the day, was already producing all of the oil that it already could coming into this conflict. So there's not a lot of headroom there. It's going to be places like Australia. It's going to be places like China. China's actually been quietly increasing production. We saw some news out of PetroChina just in the last couple of days here talking about their self-sufficiency. So it'll be some of the further flung, less well-known parts of the world. I would add Guyana, Canada into the mix. It'll be the Americas with a little bit of Asia Pacific, I think.
I note from the diary that OPEC Plus meets at the end of this week on Sunday to discuss their output levels for May. I mean, to be planning for May at the moment seems almost impossible. Should they even bother meeting, to be honest?
Well, they definitely have to meet because they've got a lot to talk about, that's for sure. But the uncertainty around planning is quite the head scratcher. I was talking with some folks who were lifting oil in the Middle East in April. They were getting their cargo nominations through for tankers to come pick up cargoes of oil in terminals inside the Gulf there. And that conversation is going on almost as if a war wasn't happening at all. So there's not that people aren't thinking about the logistics, but that there's a certain level of, I think, unacceptance that is still going on out there, or maybe a lack of rational acceptance of what's happening. That means moments like that can appear to be a little bit disconnected from what's really happening on the ground. And there's still an element, I think, of hope. And you listen to President Trump's comments, hope that maybe some kind of deal will get reached, and maybe that's what's going on as these meetings happen. So if nothing else, I think that meeting will drive a convergence between reality on the ground and planning for May.
Just to go back to the oil derivatives point you were making there, are pre-war cargo inventories depleting in the way that you would have expected?
For sure, yeah. So we see all of the available pockets of extra supply that are kind of available getting depleted in front of our eyes. So sanctions were taking off Russian barrels on the water, sanctions were taking off Iranian barrels on the water. That buys you a week of extra supply here, a week of extra supply there. But ultimately, we're talking a week here and a week there. Those inventories are running out as we speak.
You do a lot of work on benchmarks, and I know at S&P you have your own benchmarks, but what about the benchmarks that everyone commonly trades in, Brent, WTI? There's been a lot of talk in the market that Dubai and Oman benchmarks are not really accurately what's going on in the market right now. Is that your view?
Well, we've done a lot of work to make sure that Platts Dubai, Platts Oman, which represent the value of Middle Eastern sour crude oil, represent the value of the Middle Eastern crude oil markets. And those benchmarks have been as high as $140 a barrel this month, and even at times a little bit higher. And that's because the epicenter of the distress is in the Middle Eastern crude oil market. So our network of traders, suppliers, consumers are all very engaged with us on helping make sure that our benchmarks can represent the value of the crude oil in that market. It's no surprise to me that the rest of the world's oil markets are starting to move closer to where Dubai is and not the other way around.
Dave, you mentioned the signals that come from the president about wanting to resolve this. Really interesting note from Ben Emmons at FedWatch, who notices this pattern that as soon as oil starts to get to $120 a barrel, the president gives verbal signals about wanting to wind things down. The price then drops. And he's noted this pattern every time. He's saying each time the drop is less steep.
Yep.
And the crater of it ceases to, the words cease to have the same effect. What are you seeing in the energy market's response to what the president is now saying day by day?
Yeah, I think that the energy markets are very aware of the fact that there's, I think, a certain deliberate ambiguity around what is going to happen on the ground and on the water in the Middle East. On the one hand, we see troop buildups, we see more military personnel arriving, and then we see more statements of a possible deal, the U.S. negotiating with certain Iranian officials. Those two things are happening at the same time, which creates a real whiplash effect from anybody trying to understand what's happening in the market here. The critical point here, though, is the longer it goes on, the less easy it is to unwind the distress that is actually in the market today. And that's why prices are less and less responsive to the downside. We're about to pass into our second month, and already the markets are rewiring for the long run.
Okay, Dave, thank you very much. Wide-ranging and interesting thoughts there. Dave Ensberger, President S&P Global Energy. Thanks for joining us on Squawk Box Europe.
Thank you.
And we can just take a look at what is happening on the markets. This was the picture on the US markets. As we were saying, the Nasdaq now into correction territory. The Dow finishing the day just over 0.1% higher. The S&P, though, and the Nasdaq both giving up ground on the day. There was some relief in the words from the Fed Chair Jerome Powell, saying on Monday that he sees the current inflation outlook as being in check. So saying that there is no need at this time for interest rate hikes. And let's see what the situation is in Asia, because very much the risk-off sentiment, the sell-off there continues. All of the main benchmarks trading lower in the Tuesday session. The Kospi in South Korea leading the declines down more than 4%. This despite a statement from the South Korean government that it's proposing a supplementary budget worth about $17 billion to ease the burden of rising energy prices on households and industries. 5 trillion won will go towards a petroleum price cap. This is all to try and limit the impact on South Korea of the energy price spike. It is a country that imports more than 90% of its energy, so very susceptible to these price spikes. Let's have a look at what the day ahead is looking like for European equities, and a mixed picture being called across the European benchmarks. This after a session in which they closed higher, despite investors grappling with what is going on in terms of the direction of the Iran conflict. In the previous session, the Stoxx 600 climbed almost 1%, shrugging off the sell-off in Asia. We started with the US on Monday's session. Let's cast an eye into the future and what's being called across the main benchmarks when US trading gets underway for the Tuesday session. And this is the picture, a more optimistic start being called across the three main indices. That after oil prices dropped following that Wall Street Journal report that President Trump telling aides he was willing to end hostilities in the Middle East even if the Strait of Hormuz remained largely shut. Now, as I was saying, the Fed Chair Jerome Powell eased expectations that the Fed could deliver a rate hike in the short term. Speaking at Harvard University, Powell said inflation expectations remain well anchored and that policymakers don't yet have to respond to energy price increases.
We were at about 3% inflation, and somewhere between 0.5 and 0.8 of that is from tariffs. So we've been pretty close to 2% all this time. Now we have another supply shock coming. You know, it's one of those times where you get a series of supply shocks. First the pandemic, then the much smaller one from tariffs, and then we're getting now an energy shock. No one knows how big it will be. It's way too early to know. As I mentioned, we do think our policy's in a good place for us to wait and see.
Still to come on the show, rising rates deal another blow to the UK's housing sector in March. Plus, French President Emmanuel Macron prepares for a visit to Japan and South Korea. But first, we'll dig into the outlook for the shipping and logistics industry with Oscar de Bock, CEO of DHL Global Forwarding. That conversation is coming up next.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back. You're watching Squawk Box Europe. Now, the impact on air cargo from the Middle East war is being most felt in the corridor between Southeast Asia and Europe, according to DHL Global Forwarding, with altered routing leading to around 2 to 3 hours of extra fuel having to be used on the journey. Oscar de Bock, CEO of DHL Global Forwarding, joins us here in the studio. Very good to have you with us. Just explain the impact this is having on businesses and industry.
Yeah, so I mean, you were talking about air freight. Obviously, with what happened in the Middle East, a lot of capacity has dropped. So meaning airlines who can't fly, or at least can't fly at full capacity anymore. If you mentioned Southeast Asia, for instance, the route of Southeast Asia to US and to Europe was going for a large part via the Middle East. That obviously at the moment is no longer possible, or at least not attractive anymore. Because of insurance costs, because of lack of capacity. So that means that the overall capacity in air freight has reduced, and we have to find alternatives for our customers. Now, luckily, we are an airline as well as DHL, so we have the possibility to increase capacity and to find solutions on that. So you find now more direct flights from Southeast Asia chartered towards the US and towards Europe to find that solution.
And how much spare capacity is built in to the cargo and the freight system, or the freight that's carried on passenger planes? I mean, is it easy to find extra space that can be used, or is it normally running at a high capacity?
No, it's actually it's not easy to find at the moment, because as you can imagine, the amount of passenger flights. So you used to have cargo in the, as we say, in the belly of the passenger flight. Right? If you count that most of the Middle East airlines are not beyond 50% of capacity at best at the moment. So that means that there's a total drop of capacity, of global capacity, of around between 15 and 20%. So that's quite an impact. That, together with the backlog that has been created because of the war in the beginning when there was no flights, you see that there's an overall backlog. There's an obviously pressure on the market to make sure that products actually do arrive, and that actually drives rates up in air freight at the moment.
What kind of assumptions are you making on the duration of this conflict and for how long you're going to be experiencing this kind of upheaval?
Now, the political element, obviously, I'm probably not the right guest for that part, but I can tell you the logistics impact of this will be quite long, because for every I would say for every week of this under capacity, you can calculate at least 1.5 weeks to recover, because you have to do the day-to-day plus the recovery of that, and then you need to make sure that there actually is overall capacity in the market. So that will have an impact. We spoke about air freight, but of course there's also ocean freight where this has impact, right? We already are sort of get used that we have to go across Africa in order to cover the market, which added about 10 days and 15% of capacity. But now you also have insurance costs that has gone up. You have fuel surcharges that have gone up. So for us, as DHL, these are, I would say, at the times where we can add more value to our customers, right? Because to add capacity, to find alternative routes, to find alternative port connections. For instance, we also had to find for customers that where you had end of voyage, as in meaning containers that were dropped in India and in other parts of the Middle East because the ships couldn't actually come to end destination. We've been able to add capacity, land capacity, to move containers within the Middle East to end destination. So a lot of things happening at the moment, but I think it does have an impact on overall cost.
Prior to this conflict, you were looking to reduce your reliance on commercial jets, third parties and so on, and do more in-house. I presume this has added greater impetus to that.
Yeah, we always balance that, right? Because as a forwarder, as DHL Global Forwarding, we are an asset-light business in order to make sure that we find solutions that we can adapt to whatever happens in the world. And as you've seen since 2019, every 6 months there was something unexpected. So you need that flexibility. But the benefit that we have is that being part of DHL Group, you also have DHL Aviation, which is actually a quite substantial airline. So by the collaboration between the divisions, we can now also find capacity for customers where others can't.
Oscar, you mentioned that rates are going up for cargo because of this conflict. Give us a sense of how much they have gone up since the conflict began and how much higher they could go.
Yeah, how much higher they could go, that's a big speculation, right? But if you take from the beginning of the conflicts, there's lanes where it was 8% and there's lanes where it was 25%. So it differs a little bit, again, depending on the demand as well on that specific lane. So it swings a little bit between those two, but both numbers are substantial.
So 25% is the increase you've seen on some routes?
Some lanes, other lanes 8, and other lanes 0. Because it depends, of course, on the actual demand of that specific connection.
And you passing that on to your customers? Are you absorbing it, or is it a mix of the two?
Pass it on, because in the end, this is all our customers understand as well that there is a race for capacity. So if we help our customers to find the capacity, then obviously that is the market value of the actual solution that we provide.
What are you hearing from exporters in Southeast Asia and China and Vietnam and so forth? They must be pretty frustrated at all this.
Yeah, but I think, yeah, of course. But what you see in the market is that this whole agility to respond to the unexpected has become sort of something that people get used to. What I always say to customers is that be prepared for the unexpected, because it will continue to come, and it has become part of the business model to be able to respond to the various events, and that has also become a competitive benefit. The ones that are better in scenario planning and better to respond to it, and that's where we help our customers with in thinking in scenarios and then thinking in specific solutions and how you can then outperform competition. And I think that's what you see more and more in the market, that logistics and how you respond to this and the agility in that has become more and more of a competitive benefit.
Obviously, not all cargoes can be shifted from air to ships. When does shortages start to bite?
The thing is, you see also the opposite, right? Because there is stress on the actual availability of product, you see also a movement from ocean to air, because you have to be faster in order to still reach the market when there's lack of products. So you see that trend. You see the combination, as we call ocean air, so meaning that you go a part via air and then a part via ship in order to still reach the market. So you see that because of this, the trend is actually changing towards air, but at the same time, you also have, as you say, an ocean growth.
Which are the sectors that have been most affected by this, either the disruption of the routes not being viable or the costs going up most sharply?
Yeah, normally the sectors that get the first indications are the sectors that have the more time-critical products. So that's mostly when you look at the technology sector, of course the healthcare sector, but that's more specifically for destination Middle East. The first flights, the first charter flights that we did was for our healthcare customers to make sure that we could supply into the Middle East all the essence supply over there. So healthcare because of its essence, and because of the time critical part, technology because that's the whole part of a supply chain which is highly sensitive, high value and therefore affected.
And have your insurance costs gone up? Because there's been a bit of discussion around this with airlines as well.
Yeah, so the insurance cost, not so much of us, but the insurance cost of our suppliers, as in the ocean liners, as in the airlines, have gone up. As you could read this morning in the news, it's a bit different per airline. But definitely that's one of the elements, so apart from the safety, but also one of the elements why the route via the Middle East has become less attractive because the costs are actually higher because of the insurance cost.